All right, guys. So let's go ahead and get started. For the record, this class is speaking on institutional sponsorship and the origin of institutional sponsorship, as well as the lifeblood of what is smart money, and how the whole concept compares to other strategies or other ideologies. So, firstly, you have to know that smart money, right, as a concept, is a school of thought. So, what does that mean by a school of thought? Basically, that means that you as a smart money trader have to follow a certain ideology, right? And we're open to identifying and using other type of ideologies. However, as a smart money trader, you want to understand what smart money is, where it comes from, as well as how to use it, right? Because just knowing something and not applying it is just as bad as not knowing it, right? So that's something that we're going to understand today. Now, firstly, let me connect my whiteboard for you guys. You guys seem to really like the whiteboard feature, so we're gonna go ahead and use it here. Okay, let's go ahead and use the whiteboard. So firstly, I want everybody to understand what institutional sponsorship is, right? Institutional sponsorship is pretty much when the banks enter the market, right? Institutional sponsorship is when the banks enter the market and how they enter the market. So everybody here knows, right, that the market is run by the central banks. So we all know that the market is run by the central banks and the algorithm. So market is run by central banks plus the algorithm. And if you don't understand this, I will explain hierarchy of price in just one moment. So we know, right, that the market is run by the central banks and the algorithm. But when we look at how central banks actually have an impact on the market, a lot of people have trouble looking or understanding why and how these institutions have an actual impact on the market, and it's very simple. And I'll explain why in just one moment. So is actually what the props are for, right? But firstly, we're going to speak on the hierarchy of price. So, firstly, if you don't know what the hierarchy of price is, we're going to go over that right now, okay? And this is where the beginner section comes into play, right? So, let's say we have a pyramid, right? And a lot of you guys may already know this illustration, but I'm going to use it one more time to help you guys out. There are multiple layers to this illustration. There are multiple layers to this illustration, and this basically shows, right, how the market is affected, right? So the forex market is essentially affected by how much weight somebody has, right? So if you have more money than I do, you're going to have more of an impact than I do. So actually, that's something that's noteworthy to take, right? So if X has more money than Y, then X will have more impact. Okay. Does that make sense? So if X has more money than Y, then X will have more of an impact. Okay. Why does that matter in this case? Well, that matters because if you are a hedge fund, right, with only a couple $1 million in your account, and I'm a central bank with a couple billion, well, I'm going to have more of an impact on the market than you. So when I input my billions of dollars into the market, right, and I actually put in my units of currency, and you put in your units of currency, the algorithm is going to price my entry as a much heavier entry. So what's going to happen? Yes, it'll take into consideration that there is a sort of resistance from your side, right? It's going to take into consideration that your entry was calculated, right? But it will not allow you to overpower me, right? So if I'm buying a certain currency and you're selling it and I have more money than you, well, then obviously the price is going to go higher, right? Because I have more money than you. That's essentially how the market's going to work. And I want you guys to understand that, okay? So now that, does everybody have that written? I want to make sure everybody has that written before I continue. Awesome. Okay, awesome. Now we're going to go ahead and jump into the hierarchy of price. So I'm going to delete this really quickly. Actually, I'm not going to delete this. I'm going to draw another page. So let's redraw that. Okay, and this is encircled by something else, right? So let's go ahead and talk about the actual players in the market. And this is very important for you guys to know. Okay. So if you're a little bit more advanced, just bear with me. You will want to see the end of this class. I promise you. I'll make it worth your while. However, let's continue and let's say that what do you guys think is the bottom of the pyramid? Now let's actually set some boundaries for this. So we have to understand that the lower you are on the totem pole, right? The lower you are, that's going to be the bigger, right? That's going to be the majority. So it's more number, right? It's a lot more number of people, but it's the less impact, right? And the higher you are on the totem pole, then in that case, that is how that's basically the higher you up, right? That's how high you are in the food chain, right? So you're going to be higher up, you're going to have more money, more power, and more influence, right? And yeah, I see a lot of people already answering correctly. It is retail, right? This is retail. This is retail. Right? A lot of people said individuals. Yes, perfect. Individuals, right? It's people like you and I who just deposited, like a $50 account or a $100 account or, a couple $1,000 account. All that's completely fine, but we're just mere droplets, right? We're droplets in the market. Because remember that the foreign exchange currency market has around a 7 point something currency cap or market cap. It's either 6 or 7 trillion dollars. Either way, 6 or 7 trillion dollars is a lot more money than I have, right? I don't have 6 or 7 trillion dollars. So if we think about this, this totals out to around 7 trillion, right? So this is around $7 trillion. I'm not exactly sure on the exact number, but it's around $7 trillion. Right? So it's around 7 trillion. But then afterward, right, higher up on the totem pole, what do we see? What do we think? What do we think goes a little bit higher up on the totem pole? What do you guys think? Small banks, okay. Banks, small banks, okay. Does anybody have any other answers that they'd like to share? Hedge funds, okay. All are very, very good answers. All are very good answers. For me, right, when I would define this, I would say larger investors, small. I would really say hedge funds. Right? So I'd say larger investors and hedge funds. Now, why would I say larger investors and hedge funds? For the very simple reason that they're not at the scale that small banks are, because a lot of small banks are actually backed by larger banks. So a lot of them have been bought by larger banks or simply have a lot of influence from those larger banks, which allows them to have a little bit more leverage than these larger investors, investors that want to put in $1 million or $2 million into the market. They're larger than us, like in retail, but they're not so quite. They're not quite as high as as these smaller banks. Now, furthermore, we have the next, which actually you guys have already answered. So these are going to be small banks. Banks. And I want to kind of put this in a little bit of an asterisk here because I want to make a little bit of a note, right? So these can be anywhere from brokers to credit unions to stuff like that who are already sponsored by either larger banks or by the state, right? So I'd also like to include here that around this area is where some corporations will be, right? Some corporations do influence the market. They usually split up their assets between the stock market, right? Buying their own shares or buying other shares, right? And also putting it into either the foreign exchange or putting it into some other market that they like to benefit from. So in some cases, this can also be corporations. So I'd also add in a little bit of a corporation type thing, right? So it's not completely in the loop, but in some situations it can definitely influence. So after that, we have two more spaces. What do you guys think these are? What do you guys think these are? Big banks, okay. Major and central banks, okay. Larger banks, okay. Wells Fargo, brokers, okay. Well, let me ask you guys this question. What is the biggest bank of the United States? What is the biggest bank of the United States? Perfect. The Federal Reserve. So the Federal Reserve is something that has control over the U.S. currency because we can print it, right? And this last year has actually shown, right, that the Federal Reserve has more power than politicians because they can just print money, right? They can just print money and print money and print money, and who cares what the consequences are, right? But in this case, the Federal Reserve and certain governments would also go in the bottom of this poll, right? So it would be reserves, right? Reserves and government. The reason why I added reserves and government from the original boot camp where I presented this idea was the fact that the Federal Reserve has a larger impact than before really seen, because as we see now, right, the Federal Reserve has completely shoved the dollar down the drain, and we're seeing the consequences of that, unfortunately. So what are we going to say to that, right? We obviously have to include them in this hierarchy of price, or else we're completely discounting a large portion of where a lot of this monetary and institutional influence is coming from. Right? So that's something that's very, very big. Now, another one is going to be now the top, right? Everybody knows the top. Everybody knows the top. Can you guys tell me the top? I'm pretty sure everyone can tell me the top. What is the top spot? What is the top spot in these in this poll? Empire, yeah. uh Algorithm, Federal Reserve, central markets, central banks. There we go. So we had a slight slip up on the wording there. It's actually the central banks, right? Not the central markets. Very, very close though. Very good. I like how everybody answered the chat. All right. Thank you guys for your participation. So at the top here we have big banks. Perfect. Now we understand why the big banks are up there, right? We understand that they have the most money. So usually, I know that the Federal Reserve can, print money, but the biggest participant in the market is going to be the big banks, right, in the Federal Reserve. So those bigger banks like J.P. Morgan Chase, Wells Fargo, and a lot of these other ones are going to be the ones that are going to be moving the market a lot, and they're also going to be the ones having the heaviest entries. Okay, does anybody have any questions about this illustration that I just made? Does anybody have any questions? Does anybody have any questions? I'm about to make a little illustration for you guys. Anybody have any questions? Yes. All right, let's hear it. Right, right. Where would you place the algorithm? I almost forgot this. Thank you, Priceless. The algorithm, right, which is essentially what prices everything in and runs everything. Now, the reason why we say that the algorithm controls the whole market is not because it has the most money or because it's a separate entity or because of the Illuminati, whatever. It's not that at all. It's because it is the tool, right, that is used to price in these entries. So IPDA, right? IPDA, as it was a term coined by ICT, IPDA, right, or interbank. So let me actually write this. So interbank price delivery algorithm is going to be the algorithm that actually prices in whenever you put in an entry, right? So whenever the big banks go in with a couple million lots, they put in the entry, right? And then the algorithm prices it in, comparing it to the actual climate of the market and running it through certain equations, which actually price in and give us price, right? So they give us price. So whenever we as traders input a trade, no matter how big or small it may be, we have to go through the algorithm, which is going to give us what we see, right? Excuse me. Without the actual algorithm, we wouldn't have a price. Okay, it would just be a bunch of jumbled candles. Okay, but IPDA gives us a clean um, positioning system, which comes in with the market. It gives us the actual market climate and it gives us a tradable market. Okay, so that controls everything. That's why I have the circle surrounding the actual surrounding the pyramid, right? The hierarchy of uh, of price, because it prices everything in, and without it, it's a crucial part. That without it, we wouldn't have a hierarchy of price. Does the algorithm apply to the market makers, i.e., to the direct to market brokers? Yes. So it applies to everybody. I think I understand your question correctly. The algorithm applies to everybody, okay? Because if you're a big bank and you're inputting a couple million lots, right? Of course, that's not a literal number, but I'm just putting an example. If you're entering a couple million lots, what you're going to end up doing, right, is when you place that in, they don't need a broker. They are their liquidity provider, these big banks, right? But they still have to go through the algorithm because when they place it, it affects other traders, which allows us, right? Which allows us to have a fair price delivery system through the algorithm, right? So the algorithm actually helps all of us, right? The algorithm helps banks because it prices their position in such a way that they can make the most money. And then it also prices in our position so that we can make money as well. Um, I just joined, so I'm not sure if you covered who owns the algorithm. I personally don't know. I would assume that big banks are going to be the ones who run it and calculate it and everything like that. But it's kind of the same way for the stock market. So the stock market, in the same way, has a derivative algorithm, right? So it runs the algorithm, and it's just how the market essentially runs, right? So it's how the market sustains itself. So this algorithm, I would essentially say it is the market, right? It is how it prices in, and it is how these numbers come to be because it's the result of an equation. So does it put orders automatically? Yeah. So once your broker provides a certain, provides your order, it inputs it into the algorithm, and then from there the algorithm spits out a price and how it was affected. Right. That's just for us. Right now, for the big banks, since they don't have a broker, they are their own liquidity provider. What's going to happen is they input that price, and then they input their order. Right. Say it's a sell on EJ. Right. For whatever it may be. Of course, that's not how it actually works. There are contracts involved, but I don't want to bore you guys with those details. What's going to happen is that algorithm is going to price in that there are a certain number of lots, let's say, like 3 million lots, and then the market is going down a certain way, right? Because of the amount of orders that are coming down in that as a result of banks entering that market. Now, I want you guys to take a look at this little example that I have set for you guys. So I have a little thing of water, right? I have a little thing of water. Now, with this water, I'm gonna head and put it here, right? With this water, we have it in a little glass, right? Now, when we have it on this glass, what's gonna happen if I input something extremely heavy into this water? Actually, let me stop sharing really quickly so I can just share this with you guys. So now that we're all looking at it, right? Now that we're all looking at it, we're looking at this glass, right? And this glass is going to be the perfect example of what I want to show you guys. So this is the $7 trillion cap market, right? Now, of course, it isn't all the way up. It's, around the medium because usually the market doesn't, move all of that huge amount of money every single day. Sometimes there are lower liquidity days, sometimes there are higher liquidity days. But either way, we have this full glass of money, right? Now, what would happen if we were to drop something very heavy? In this case, it's not very heavy, but we have a couple ice cubes, right? Now, what's going to happen to the water level if we input these ice cubes all at once? What do you guys think is going to happen? The water level going to go up or down? Water's going to rise. Now let's actually test this out. Okay. Now what happened to the water level? Does it look higher? Does it look lower? The water looks higher, right? Why do you guys think that the water looks higher when we put this glass when we have this glass of half filled water, right? It was around here and now it's raised all the way up here. Why did this happen? Volume was added. Perfect. Volume was added. This is exactly what the bank does. Okay. Now let me explain this example. These ice cubes that we just added, right? They are going to be bank orders. Whenever we add this large amount of volume into the market, what do you guys think is going to happen to the actual net move of the market, to the net mass of the market? It's going to go up, right? So the water level was around here. We input the ice cubes and now it goes up. Okay. It's the exact same thing for banks. Let's put it this way. A bank is going to input orders, right? That is going to create a splash or it's going to add volume into the market. Since it adds volume into the market, what's going to happen? We're all going to see it. We're all going to feel it, right? Because we're all a part of this market. But if a large entity starts stepping into this market, right? Let's say we put in a block of ice, it's going to go up so high that it overflows, right? Because we all feel it. Okay. So whenever we see a bank enter, that's institutional sponsorship. Okay. Because they move the market in such a way that is favorable to them. Okay. So if they want the volume of water to go from the middle, right, all the way up here, the only thing they need to do is add more ice, which to them is add more money. So if they want to, let's say they want to move GU from 1.3 to 1.5, that's a bullish move, right? Say they want to do that. What do they need to do? If GU 1.3 is right here and GU 1.5 is right here, what do they need to do? All they need to do is add ice. Right? That's the little example that I want to give you guys. Does everybody understand that? Did everybody get that or is somebody lost? Now I want to take a little drink cuz that's a lot of talking. But yeah. So, does everybody understand this example that I just gave? Does everybody understand that example? Perfect. Does anybody have any questions up to this point? Anybody have any questions? No? Okay. Everybody understands. I'm going to assume everybody understands. All right. Now, let's go ahead and I'm if you guys see me look down, I'm just looking at my lesson plan here. I'm going to come prepared for you guys. So, now let's talk about how this algorithm prices in, right? And how this algorithm actually, when it prices in a certain amount of money, there's going to be liquidity, right? And we want to define and redefine liquidity. Now, there's a quick question. Would the big banks ever want the market to go down? Yeah, they can either move it up or down, right? So in this case, all that they need to do is, right, the market's going to move no matter what. Now, in this case, it's a little bit difficult to explain a bearish situation, but all that banks need to do, right, if they were to go in a bearish situation, all that they would need to do would go the other way. It would be go the other way. So if they want, so remember, if you want GU to go down, right, you have to buy a certain currency to devalue the other. Now, if we're going in the opposite direction, right, and you want it to go up, you have to buy another certain currency. Okay, so it's a little bit of a weird example to do it for bearish examples, but yes, it would be the same exact thing just flipped. It would be the exact same thing just flipped. So the big banks would want they want price to go wherever they make the most money. And this is actually something that we're going to touch on our next topic, which is liquidity. Okay, so we're going to define and redefine liquidity. Okay, let's actually go ahead and pull out the whiteboard again. Pull out the whiteboard again. All right. That for you guys. Because USD and gold is an inverse correlation, and it is the algo that creates these opposite moves. No, that's called smart money divergence. Okay, I'll so we don't get off topic. I'll explain smart money divergence near the end. Okay, so just stay on. I'll explain smart money divergence near the end. Okay. Now let's go ahead and start. So we have liquidity, right? Liquidity can be a couple things, right? Liquidity can be, it's essentially money, right? The literal definition of liquidity is money. Give me one moment. My pen just fell. All right, sorry, my pen fell. Anyway, the literal definition of liquidity is money. Okay, so if you guys want to like have a simple, easy to understand term of liquidity, right? It literally means money. Okay? It literally means money. Now, how is money calculated in the market? How do you guys see how do you guys see liquidity calculated in the market? So I just told you guys, right, that when a bank inputs an order into the market, the algorithm prices it in such a way, right? The algorithm prices it in such a way that it affects the rest of the market. So if an order affects the rest of the market, how do you guys think liquidity or money is calculated in our market? Perfect. I love both of your answers, Sanjay and Mitch. I love both of those answers. Perfect. So it's buyers for selling orders, right? And it's orders waiting to be filled, limits and stops waiting to be hit. So I'm going to literally just reduce all that to one word. Caps, so you guys can understand. Orders. Okay. Orders are going to be how you calculate money through the algorithm. Okay. So orders are going to be money, whether they be filled, unfilled, running, pending, whatever the case may be. That is what creates money in the market, right? If you had absolutely zero orders in the market, how would that look? If you had zero orders in the market, how would that look? Like a line. Exactly. Perfect, Mitch. It would just be literally this. That's all it would be. Price stays still. It wouldn't move at all. Perfect, Jay. Right? It wouldn't move at all. So, because of that, if price is moving, it obviously has to have some type of orders that are pending, that are running, that are going, right? That are waiting to be hit. Either way, all of these orders are already, pending. So, because of that, I'm going to share an example to you guys of how liquidity can be defined in the market. Um, Level 2 shows liquidity at various price points in visual form. Level 2? Not sure what you mean by level 2, but yeah. So it shows liquidity at various price points in visual form. I'll show it in visual form. Yes. So, all right. So essentially, right? Uh, does Forex have this just as stocks? You mean showing liquidity at various price points? Yes. Yes, that's how we trade. We trade with liquidity. And actually, our style of trading works with stocks, works with commodities, it works with volatility indexes, works with everything. It even works in crypto. So one of our educators actually specializes in applying this type of trading to crypto. So if you want to catch some of his classes and ask him, it's actually Garrison or Gary FX. He's very gifted when it comes to crypto. He's very good at it. So continuing on, um, penny stocks as well. Yeah. And remember, when it comes to any type of trading, there has to be an algorithm managing it. There's absolutely no way somebody can manage a every single order of millions and millions of people who are trading this market all at the same time. There's no way. There's too many numbers. So what do we do in this era of technology? Right back in the day when stocks were managed manually, then yes, people would have to sit down and run these numbers and crunch them and then put out the price that it's actually at. Right? But there would be dedicated like large amounts of people to do that. Now, later on when technology was starting to arise, that's when these algorithms started coming out. Now they were improved and moved over time, and now we just have a standardized one that most of these markets use. And if they don't use the exact same one, they're going to use one that is extremely similar. That's exactly like I was explaining to Michael, one of our students. He was saying that he was asking, um, how does this affect stocks? Well, in the same way that forex is moved by orders, right? It may not be the exact same algorithm that is used in stocks, but it's very similar. It's still institutionally manipulated, meaning that they can pump price. How many times in stocks have you guys seen price literally do something like this? And let me actually move to another page. How many times in stocks have you guys seen price just consolidate for weeks and then just do that? And then just immediately after, the next day, it does something like that. Immediately after. Me, I started in stocks about 4 years ago. I've seen that many times, right? And I've also seen the other outcome in which it starts dropping, it recovers, and then it keeps going up, right? Do you guys remember Kodak? Do you guys remember Kodak a while back? That went from how much? Like $4? It went from $4 to like 32. Do you guys remember that? All of that was institutionally manipulated by one person, which was President Trump, right? That's literally he said something about Kodak and Kodak shot. People think, oh, well, everybody was buying Kodak. Remember, the value of something, whether it be a currency, whether it be a stock, whether it be an asset, is the value that is given to it is the willingness to buy of other people. So if I gave you the most valuable thing on earth and you didn't find it worth your while to buy it, it would have no value. Okay. That's exactly what I want you guys to get in your head. That is institutional manipulation. That is institutional sponsorship. They find it worth their while to buy these things and to make different kinds of money. So whenever these companies and these institutions amass their money right here, right, and then they just shoot it. This is known as power of three, which we're going to get into later on. It's going to be near the end. Okay. But right now, I want to give you guys an example to define and redefine liquidity. Okay. Does anybody have any questions that we want to cover up until this point? Please, guys, don't be shy. I would rather you guys ask me this question now and understand it now rather than you lose money later on. Okay. All right. It's good to see that you guys are eager. No questions? Perfect. Go. This example is going to be drawn. I couldn't find the actual example. I couldn't find it. It happened back in August, but I'm going to draw it back to the best of my memory. Okay. So this was in gold a while back. I forgot when it was in August, like I said, but I couldn't find it. I was trying to search all day for it. I couldn't find it. But let's say that price starts around here. Then it trades up. It creates an equal high. Then it creates an inefficient low. Comes back up. Okay. Now at this point, we have a couple things that we want to establish. Firstly, I'm drawing this as a line chart just to get the general idea of to give you guys the general idea of how this happened. Right. So basically, this created an equal high, right? And this was trading in a range. So it wasn't trading like anything crazy. It wasn't anything special. And a range is literally just consolidation. This is a range. That's a range. That's a range, right? That's literally what it is. So if you guys don't know what a range is, this is a range, okay? Now it was trading within this range. However, when we understand liquidity and we understand the players of the market, we have to mesh these two topics together and understand how to see them in the market. Excuse me. So, firstly, let's say that you are a bearish trader. Let's say that you're in a hedge fund, right? Or you're a larger investor, right? Because of the amount of orders that you have in your portfolio, as well as the amount of orders that you have actually trading within the market, you have somewhat of an influence. Let's say you have somewhat of an influence. Now, let's say you're a bear, right? And let's say you pushed price from around here and you sold from around here. And now let's say also you sold from around this area. Now, you may not do this, right? You may not do this, but a lot of these larger investors will not take 15, 20, 30 pips, right? It just isn't worth it. It isn't worth it. They're going to hold for these large moves. They're going to hold for these moves that give them thousands of dollars, that give them, these millions of dollars in the market because that's what they want. They don't want a couple hundred, right? They don't want a couple thousand. They want a large amount of money. So what are they going to do? Obviously, they don't want to take losses. They don't want to take losses at all. So what do you think they're going to do to protect their entries? Now, keep in mind, it is not as simple as just closing out a trade for a lot of these. It is not as simple as closing out a trade because to them, they have to actually buy the physical contract. They have to find somebody in the opposite party willing to buy, right? Or willing to buy their contract off of their hands. And then that's how they close their trade. Okay. That is how they close their trade. So it's not as easy as just breaking even or taking a small loss because a lot of times people don't buy these contracts at the exact same spot where they want to sell them, right? So they have to protect themselves. How do you guys think a lot of these funds are going to protect themselves? How do you guys think? Hedging, right? A lot of them are going to hedge, but most of them don't actively hedge because they favor one position. So what are they going to do? Now, for this exercise, I'm going to make a quick clarification. Red lines are bearish. Red lines are bearish, lines are bullish. We have a couple questions. What does hedging mean? How do they hedge? Hedging, hedging is simply the act of buying and selling at the same time. All right. So let's say you let's say you do this, right? Let's say you sell here, right, and you buy here. Actually, I should have probably drawn that in red. Let's say you buy here. Let's say that you sell here, right, and then you buy here, and then price starts ranging. Okay, you're both in a buy and a sell. You can't lose. Well, theoretically, you can't lose. In practicality, you can, but theoretically, you can't, right? And that's essentially what banks do. So they get in both ways. They both buy and sell. Now, let me show you how they do hedge. A lot of these institutions will cause a buy. So larger institutions will, get out of early time, of earlier sells. They'll take some profit, which will shift the market in a certain way to move, the market into a buy. So to not confuse anybody, let's just say, right, that these banks actually offset the risk. Perfect example, perfect choice of words actually. Hedging is offsetting risk. Yes, basically. Example, buy Bitcoin to hedge against the US dollar in decline. Kind of, but Bitcoin isn't a security. And I actually dislike Bitcoin. But yes, what you're saying is correct. So basically, it's saying, okay, well, the US dollar is declining. I'm going to get into this other asset, to actually, you know, offset the fall of the dollar. So if me as a lower a wage earner, and actually I spoke about this on my podcast, which is somehow still uploading to YouTube. I apologize for that. Um, but I spoke about this exact thing. So if you guys want to go look at my podcast when it decides to upload, then you guys can very very easily understand what I'm saying because I actually dedicate like a whole hour to it. So you guys can go listen to that. However, back to this example, how do we see money here? How do we see these orders? How do we see these orders? Well, think about it this way. Let's say price was continuing from somewhere back here, right? Price obviously had an origin somewhere back there. So if we know this, what do you think is going to happen, right? What do you think is going to happen when us as traders see the market pivot right here? What do you guys think happened when the market pivoted right there? Was it just some random act of the algorithm or was it something different? Obviously, the algorithm caused it. Perfect, right? It was entered sell orders. These entered sell orders caused the algorithm to price in money, to price in the price of this pair, right? In this case, gold. It caused the algorithm to price in a bearish fashion, right? So remember that our charts, right? How we see charts, and this is going to be a little bit of a complex idea, so please just bear with me, okay? The chart that you see, and this is for all my math nuts out there, the chart that you see is a chart of price over time. Okay. It's a chart of price over time. Now, what does this mean? Put very simply, put very, very simply, every single time that the algorithm calculates an order, it'll put it in as a dot. Let's say it'll put it in as a dot, right? In this case, since we trade with candles, it enters it as a piece of data in a candle, right? And it puts it as a piece of data on a candle. Now, let's say over the next 10 seconds, there are 10 more entries. Let's say it's one piece of data per second. If it calculates, let's say it calculates this as a 5. Let's say, look, just for simplicity's sake, let's calculate this as a 5. If it inputs a 6, it'll obviously have a higher price. So it'll do like this, right? And it'll input as a 6. Now let's say straight after that it calculates a 3, right? So it'll drop to a 3. Let's say from there it goes to a 4. Then it comes right here as a 4, right? So do you guys see this? And this creates a chart by doing this. That creates a chart by doing that. Do you guys see how the algorithm creates the market? And do you guys see how time frames are so important here? Because if you're on the 5-minute time frame, then every 5-minute interval you have a different piece of data. You have a different number that the algorithm gives you. And that is how price is created. Does everybody understand this? I didn't lose anybody, did I? So everybody understand that the chart that you are seeing, it is price over time. The chart that you are seeing is price over time, okay? Because it is what price it is over a certain interval of time. So if you're inputting, let's say you're the algorithm, right? And okay, so somebody said not really. What are you not understanding so far? Where can I help you? Okay. So think of it like a line plot, right? Think of it like a line plot. That's how I explained it here, right? Let's say the algorithm prices in it prices in all of the data that it has stored up, right? It prices in all of the data that it has stored up, and it prices in right over it. Let's say it's on the 5-minute. Let's say it's on the 5-minute chart, right? And this is just for an example. Let's say it spits out a number and it says that it has calculated price to be at a 5, right? At a 5 value. I'm just saying as a value, right? That is the price, 5, whatever currency, right? Let's say $5 to keep it simple. Let's say $5. Now afterward, the next 5 minutes, right? It calculates again. It calculates again, and then it spits out another number, and it says that it is valued at $6. Okay. Now, in the next 5-minute interval, it comes out and it says, okay, I've calculated it. The price is now $3. The next 5-minute interval, it clicks again, right? And it says, okay, I've come up with a new piece of data. What is the price? Well, it is now $4. Okay. Now, when we have this, right, we have these little dots in the market, right? Let's replace all of these lines and numbers with just dots, right? Let's replace all of these with just dots. Now we understand that it's 5, 6, 3, 4, right? A dot here, a dot here, a dot here, and a dot here. Now, if we connect these dots, we understand that over the last 1, 2, 3, 4 intervals of 5 minutes. So if we times 5 times 4, that's 20, right? Over the last 20 minutes, we have gone from $5 to $6 to $3 to $4. And that is how price is calculated by the algorithm. That's how price is calculated by the algorithm because it runs price, right? It runs all of the factors in the market through its calculation, right? And then it creates its chart from there, basically. Now, how do we see this in the market? Like I said before, these are simply stated, represented by orders. So we know that there is liquidity here because of the fact that these orders are already active and they're selling. However, that's in hindsight, right? In foresight, right? If we want to see where the price is going next, what do we need to see? We need to see where price still has orders that are not yet in play. Okay, we need to see where orders are not yet in play. So these are already in play. We don't necessarily want to touch them, right? Because they basically have nothing to lose from this positions, right? They have nothing to lose. So what are we going to think? But what do you guys think? What do you guys think? Do you guys think we're going to have it above or below these sell orders? And I'll give you a hint. It's a stop order. What do you guys think? You guys are kind of quiet. Did I finally trip you guys up? Above, okay, above. So, right. I feel like some of you guys may not know what a stop order is, so I'm going to go ahead and explain it really quickly. So, a stop order is essentially, let's say price goes is selling, right? And you put in a sell stop right here. What that is telling your broker to do, what that is telling your broker to do is as soon as price runs through this runs through your stop, right? Runs through your stop order, it will get you into a sell. So this is a pending order, right? The blue line is a pending order. But as soon as price touches that line, just like a take profit, just like a stop loss, right? It will trigger and you are now selling from the point that you put the sell stop at. Does that make sense? So it basically goes through. So let's say you want to make sure that you don't miss this sell, right? You think that there's a very big sell coming up, right? And you put in your sell stop right here, right? And the price can do whatever it wants, but as soon as it drops, you have now sold from the price that you put your sell stop at. Okay, that is a stop. Now that can be a sell stop or a buy stop. It's the exact same thing, just flipped. Okay, so a buy stop would be the exact same thing, just flipped. Oh, price is consolidating there. I know that a big buy is coming. Boom. Right, and you bought from this point. Does that make sense? Does everybody understand that? Perfect. Okay. Now that everybody knows what a stop is, now that everybody knows what a stop is, these hedge funds are going to protect their bearish position by hedging, as we said earlier. But how do they hedge? Easily, they hedge by placing buy stops above their orders. Not only will they do that, but they'll also put their stop loss in front of their orders just in case, right? But they will put buy stops above price. They will put stop losses, sorry, not stop losses. They will put buy stops above. These are going to be buy stops. These are going to be buy stops, right? Now, what does that mean? That as soon as they think price, shoots back up, they're going to, in this case, right, they're going to trigger into a buy. Right? They're going to trigger into a buy and catch it on the way back up as a means of kind of mitigating risk and saying, well, if we get caught off guard and this pair just immediately shoots back up and like takes out our other orders, well, we're not in that much of a loss because we also bought the other way. Now, let me tell you how sneaky banks are, that they will make full full use of people, of investors, of hedge funds, of smaller banks who are not in the loop or who are going against these major banks, how they take complete advantage of them. Okay, so in this case, we have a couple things. Now, this up here, these little buy stops above, they are what we call these little money signs. Now, in a lot of smart money charts, you will see these little money signs. These little money signs just mean liquidity, or LQD um as some people call it, right? Liquidity. That's essentially what they mean. What does that signify? Liquidity usually is found at previous highs, previous lows, and wherever you may think either stop losses or pending orders are at. Okay? So let me actually write this down really quickly. Okay. All right, so let me actually define liquidity. So found at recent or previous, right? We can put it at P PH, or previous highs, PL, or previous lows, right? You can also find it wherever you believe that pending orders and liquidity. Oh, sorry, stop loss. So previous highs, previous lows, pending order, wherever you think pending orders are placed, and wherever stop losses can be found. Okay. Does everybody have this written down? Does everybody have this written down so far? Perfect. All right. So from here, let's go back to our example and actually understand this example. Curious if many people who just enter trades with no stop loss or target that theoretically impact liquidity. Yeah, they would, because they're still running entries, right? So they still had to enter somewhere. Now these are just where major areas of liquidity or liquidity pools, right? So these up here, these stops, right? This area above it, right here, this is known as a liquidity pool. Okay, and those pools essentially allow price as a whole, right? They allow these banks to have a target to where they can take profit, to where they can secure certain money, and to where they can actually make most use of their money. Because if they want to institutionally push price upward, they're going to have a target, right? And that target are these liquidity pools. So this is one liquidity pool. The other liquidity pool would be up here at this previous high, right? Because that is where a lot of stop losses, right, from people who were bearish at this top position, right? And a lot of buy stops can actually be placed there, right? That is what I mean by liquidity pools. Okay, I hope that answered your question. Now, what you should also notice is that people that entered here, 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 and they didn't have a stop, that's completely fine, but they have margin, and they also have a lot of they're also very nervous, right? So if price suddenly shoots 500 pips, they're either going to get margin called, or they're going to be very nervous and close out of the trade, right? Because they're going to be in heavy loss. That's what I mean by liquidity. Anywhere where somebody would give money back to the banks, right? Because where do you guys think that where do you guys think that your money, when you lose it, goes to your broker? And a lot of your brokers are owned by these big banks. So where does it go to? Essentially straight back to the big banks. So they gain money whenever they stop you out. That's actually a point that I should have touched on earlier. So a lot of your brokers, right, are owned by bigger banks. Now, a lot of these bigger banks are going to be a lot more lenient, right? And they're going to let you, they're going to let their providers pay out, right? They're going to allow they're not going to trade against you. That's why I personally prefer Eagle FX because they're owned by a smaller bank based out of Florida, I think. And they're actually very transparent about it. They're very good. They're honest, and I've never had any problem with them. So that's what I like. That's why I like them. But at the same moment, if I lose money, if I lose money, then it'll go back to them, right? So wherever they get their liquidity or wherever whoever sponsors them is going to go back to them, right? So they're going to essentially get the money, right, that I'm losing. So now that we understand that, let's go ahead and use this in a practical application. So whenever we see where liquidity is, we know that liquidity is in two places. We know that liquidity is here, or major liquidity, I should say, to not confuse anybody. There can be liquidity in the middle. There can be liquidity here, 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 wherever you want and please, right? But remember that banks don't care about your $100 account. Banks don't care about that 500. Banks do not care about that $500,000 account. They care about the vast majority of money which can be found up here in this liquidity pool and at this liquidity pool up here. Does that make sense so far? So we obviously know that they need to go towards their targets, which are at liquidity pools. So keep this in your notes. Bank targets are at liquidity pools. So train your eyes to see liquidity pools. Okay. All right. Let me repeat that. Let me repeat that. And let me admit these two people who are in the waiting room. Sorry. Um, let me repeat this. So, liquidity, the definition is here. Next, liquidity pools. Areas of major liquidity where banks have their target set due to the high monetary payout. Okay. Does this make sense? Does everybody have this definition written? And I'm sorry for my bad handwriting. It's hard to write with this tablet because of the pen being so small, but yeah. Okay, perfect. Now let's go back to our example. Now, we know that the bank's targets are up here. Now this is towards the buy side. So what we call this is buy side liquidity. So these two areas, right? This area right here, so 1 and 2 are all BSL or buy side liquidity. Okay. Can you go back? I didn't get to finish right. Yes. There you go. Liquidity pools are the area of major liquidity where banks. Oh, okay. You wrote it. I'm sorry. All right. There you go. Let me know when you're done. It's also a good time for me to get water. All right. Zay has it typed there in case you need it. All right. Awesome. So now we understand that everything that I say here can also be used in the inverse, right? So we have buy side liquidity here. Say that this chart is literally taken and flipped. That is now sell side liquidity. Okay. So this is BSL, and the other one would be SSL, or sell side liquidity. Okay. So this is sell side and this is buy side. Now, if it's above, it's buy side. If it's below, it's sell side. Okay. So if it's above, it's buy side. If it's below, it's sell side. Everybody got that? If it's above, it's buy side. If it's below, it's sell side. Somebody type that in the chat. If it's above, it's buy side. If it's below, it's sell side. Okay. Proceeding. We understand that this is now buy side liquidity, right? Both of these targets are now buy side liquidity. This here and this here. This acts as a price magnet. Okay. So this acts as a price magnet. Now, what do I mean by a price magnet? Basically, it gives banks a goal. It gives banks a target. It gives them a reason why they should return to this area. It gives them a, you could say, like a return on investment. Because when they push up and when they manipulate price to go upward, they have to have a reason why they went in that direction. They won't just simply go towards that direction because they want to, because, oh, they just felt like it that day. They do it because it will give them a certain return on investment, right? That's the reason why. So, having this buy side liquidity and having this sell side liquidity is, you could say, the argument for the market to say, hey, banks, you should come back here and take this liquidity. Okay. So we know that we have a bullish tendency here, right? Because if everybody understands premium and discount pricing, everybody will know that, in this case, premium is below the equilibrium or below the 50%. And let me actually mark this out really quickly. So if you don't understand what premium and discount is, I have a class on it completely free again. And you guys can go look at it on our YouTube channel. It's literally just premium and discount, okay? And literally premium and discount is quite literally a very easy concept. It's just that the 50% of the market, the 50% of a range is the equilibrium price. Percent of a range is an equilibrium price, right? So it's 50%. Anything below this is discount. Anything above it is premium. Okay. So anything below it is discount and anything above it is premium. That's very simple, right? If I gave you, let's take for example, these earphones, right? If I gave you these earphones and I wanted to sell them, right? They were like $300, right? When I first bought them, right? They were like $300 when I first bought them. So let's say I wanted to sell you these earphones, right? And am I going to sell them to you at a premium price, or am I going to sell them to you at a discounted price? If I'm a good business person, right, and I'm the manufacturer of these earbuds, right, and nobody in the market has anything like it, what I'm going to do is I'm going to give it to you at a premium price, right? So if I got it made for $300, I'm going to sell it to you for 400 because I make a profit, right? Now let's say I'm a buyer. If I'm a good buyer, right, and you're selling these to me for $300, I'm going to wait until you give me a discounted price, until you give me a price that is lower than the market value, right? Or the equilibrium, the 50%, and you give them to me for $200. And then I'll buy them from you. That's the exact same thing, just put on a chart. Okay. So the lower it goes, the more willingness there is to buy, which is what discount is for. Now, of course, it is required for you to, read the room a little bit. And if you see, that price is just completely falling out, like at the end of a barrel, don't buy it. But you have to understand that discount and premium These PD arrays are simply for you to see where price is more likely to return to. So in this case, if we're looking at it this way, we can understand that premium, right? Premium right now was up here, was up above the 50%. However, we have a bullish case for gold, right? We have a bullish case for gold because of these two liquidity pools upstairs. So that's, the targets that these banks are getting. So these banks want these two targets, right? They want the money that's hidden in those liquidity pools. So what do they need to do? They need to push price back to discounted pricing so that they can, one, amass as many entries as they can, and two, they can trigger limit entries that they have. So if we look at this situation, we have two things. Firstly, we have a fake retail trend line. We have a fake retail trend line. And actually, I'm going to quote the guy who taught me how to trade. um, well, one of the guys who taught me how to trade, and he calls this a trend line phantom. Right. So this is straight from ICT. So credits from ICT. Right. He shows the trend line phantom. Now, the trend line phantom is essentially you take a trend line, right, and you put it on a piece of price. A lot of times you will notice that there's going to be a point of interest below in which price comes back and takes liquidity. In this case, we see a very obvious point of interest, which is where? Right here, right at this order block. Right here at this order block. Now, when we see this order block, we understand that price is going to come down towards this area to capture it, to capture this liquidity, right? To take it, to trigger their entries and move, right? Because a lot of banks will put their limit entries. So what are they going to do? Well, they're going to stack their entries, right? They're going to stack their buy limits, right? And if you don't know what a limit is, it's very simply, let's say you have a buy limit here and price is above it. When it drops, you will go into a buy. Okay, you will go into a buy, and you're expecting it to reject off of your limit. Okay. Now, they will have a lot of buy limits here. So they'll have, a buy limit here, a buy limit here, a buy limit here, a buy limit here, wherever the case may be, right? They'll have a buy limit within this order block because that is the origin of the move that pushed price upward, right? So this order block is the origin of a move that pushed price upward, okay? So they're going to go for the 50% of this order block. So if you fib it out, it's going to go for the 50% of this order block, okay? It's going to go for the 50% of this order. Very nice. So from there, what are we going to do? Well, from there, we can also follow in their footsteps, right? Because do you guys remember my example with the glass of water? They are going to move price very quickly towards the downside, take all of the retail stop losses, right, that they possibly can. They're going to take as much money as they can, and they're going to prepare a fast and strong move upward from this order block. Okay. So what are they going to do now? What can we do? The only thing that we can do is just like when you drop a big ice cube into a glass of water, it very suddenly moves up. Well, in this same case, we can expect price to move extremely fast and extremely hard very quickly, right? It'll move it very, very quickly. It'll move a certain distance very, very quickly, right? And this is known as momentum. So it'll catch high momentum. It'll go high speed into high momentum, right? And it will reject off of the limits that banks have placed. Now, since we're not banks, I can't tell you you know, the exact time, the exact, the ratio that it'll go. But I can't tell you the area where it will reject off of. And in this case, it's the order block, right? It's the bullish order block found below. That's where a lot of these banks are going to put a lot of their orders. Now, touching back on the algorithm is like an order block is a landmark, right? The order block is a landmark of how the algorithm has priced in these bank limit entries. We know that this is liquidity, right? Because these are now pending orders from the banks, right? So they just dropped their ice cube into the water. Now, the water level is about to rise. The volume is about to rise. So, what do you guys think is going to happen? Us as traders, we can see this landmark that the algorithm has given us. And then from there, boom, we can put our limit, right? Our buy limit right at the same place that we can find a lot of these other limits at, right? Now, where's price going to go? Well, it's going to dabble around, around premium, around the equilibrium, and then it's going to completely drop, right? And from there, it's going to respect the 50% of our order block. Going to respect the 50% of our order block, and it's going to shoot up very quickly. It's going to shoot up very quickly. Now, where do you guys think the target is going to be? Where do you guys think the target is going to be? The topside liquidity, right? Why do you guys think this topside liquidity is going to be our target? Because as I said, right, that liquidity pool is the target for the banks. That is the case that was made for them to actually input a lot of lots and a lot of money right here at this area, right here at this order block to push price higher. Okay. Are liquidity pools the same as order blocks? No. Order blocks are a landmark, right, that is presented by the banks, that is presented by the algorithm, and how it prices in orders that were placed, right? So orders had to be placed to create this order block. A lot of buy orders had to be placed to create this order block as a landmark for both banks and traders to know where to put their future limit orders once they collect liquidity. Okay, so these liquidity pools are targets. It's where money can be taken by banks. Order blocks are the origin of the move that banks make. So they're essentially a landmark saying, hey, in this case right here, we're going to enter again off of this order block to move price higher. Um, Mitch asks, in a situation where both sell side liquidity and buy side liquidity, price will tend to go to the closest liquidity first. Is there a path of least resisting that? Yes. Actually, it's so funny that you say it because that's exactly how I say it in a lot of my classes. I say path of least resistance. I literally say it like that. um, Price will go to the closest liquidity, or to the, well, not exactly to the closest liquidity, but to the liquidity that it makes cheapest sense to go to. So they are lazy, right? They do not want to overextend money more than they have to. So if it's cheaper for them to go to an order block that is closest, sorry, to a liquidity pool that is closest, they're going to go to the liquidity pool that is closest because it is going to be the one that is cheapest, right? So it's the cheapest liquidity that they want to take first, and then they're going to just ramp up, double down, and go for the higher liquidities. What is a good time frame to see an order block? Price is fractal, meaning that price is going to be affected on both. Like, the 1 minute chart will affect the 5 minute chart, which will affect the 10 minute chart. So if you see let's say you find an order block on the 4 hour chart. If you go down and you still see that order block on the 1 hour chart, that's usually a good order block to take. That's kind of like a little trick that I use, right? If it's on the if it's on the 1 hour, right, and then it's on the if it has to be on a correlated time frame. So if it's on the 4 hour and you see it on the 1 hour, try to take it, right? If you see it on the 30 minute or on the 1 hour and it's still there on the 15 minute, try to take it, right? If the liquidity, if the order flow of liquidity is pointing towards a reversal to your from your order block, then by all means take it. So what's a good time frame? All of them. All of them are good time frames to stay on order block. Awesome. So this trade, how I traded it, it went straight to the pip, right? It went straight from this trend line all the way down to this order block, the 50%, and boom, it shot right back up, right? It shot right back up. It took the first piece of liquidity, right? It took the first liquidity pool. Then once it took this liquidity pool, these buy stops have now been activated, right? These buy stops have now been activated. So if banks don't want to give they don't want to give any money to anybody. They want to keep all the money to themselves. They're greedy. They're lazy, but they're greedy. Oh, sorry, Edgar. This is smart money, right? Yes. So smart money and Wyckoff, I believe you're asking, they are both correlated. We use Wyckoff in a different way, right? Which is how we teach it. Um, you don't always have to wait for Wyckoff. A lot of times you can just take these orders by taking the order block, or taking inefficiencies, whatever you'd like. But yes, this is smart money. By the way, if you guys do not know what an order block is, I'm going to send a video in the chat for you guys to understand what order blocks are. Will I cover inefficiency? No, I will not. It was not in my plan. Okay. Oh, whoops! It's everyone in the waiting room. How do I just send it to everyone that's not in the waiting room? Everyone in meeting. Here we go. Perfect. Boom. There you go. Does everybody see it? I'll also drop it in the Discord chat. I'll drop it in the discussion of the Discord chat. There you go. No problem. Okay. So now back to the example. When we see this example here, right? We've taken our first target. Now, banks don't want to give money to anyone. They don't want anybody to get money. They want to stick with all the money that they possibly can, and they don't want you to get money. Okay, they just don't want you to get money. Sorry, Darnella. I get so confused with the buy sell limits, buy sell stops. What's a good way? What's a good way for me to get really good at understanding these? Okay, let me pull up a picture really quickly. I'll send it in the Discord chat, and let me see if you understand this. Okay. I'll put this into discussion, Darnella, and let me know if that helps you a little bit. We actually haven't made a video on this, but we're going to be doing some really cool stuff soon, and we're going to actually get a we're going to get professionally filmed for all of our actual videos. So keep that in mind. Okay. Oh, Audrey did a video on this last week. Oh, perfect. So, um, Audrey, I think you guys can look at Audrey's a beginner class. I'll ask her for the recording, and I'll send it over to you. But I did send pictures up in the Discord chat. Did you see that? It's in the discussion log. Okay. And if you still have trouble with it, I'll explain a little bit more in depth once we're done with class. Okay. Now, please, guys, we're going to get a little bit more advanced here. So, if you guys are having a little bit of trouble, let's bring it up in the next beginner class. Okay. There is absolutely no problem. If you guys have any questions, you guys can ask the questions. But I'm going to move a little bit faster because the last part of our lesson plan is going to be covering a variation of Power of Three, right? And it's going to be quite interesting for a lot of people. So, uh, what banks are going to do, right? Once they've triggered this buy stop, They know that they've triggered that buy stop. However, what they're going to do is they're going to pull back. Where are they going to pull back? Again, to take as much liquidity as they possibly can, right? If they're going to take as much liquidity as they possibly can, once they have triggered this buy stop, they're going to try to stop out that buy stop. They're going to try to say like, "Oh, well, okay, like we just got stopped out here, break even, that's fine, but at the same time, we just triggered this buy stop, so, it should go up." Well, it doesn't go up. And now they're in loss again. So a lot of people are going to start freaking out. And what they're going to do is they're going to have, like the stop loss around here. And the effort of this retracement is for the banks to actually take out those stop losses and get more liquidity. Right. So let's say price just consolidates around this area and ends up going lower, right? Racing. Now it comes back up. And now it comes back and it pierces this top liquidity pool and it reaches its second target. All of this having bullish, complete bullish order flow, right? Not one singular suggestion of bearish order flow. It's completely bullish, right? And we rejected off of a previous order block. We took the first liquidity pool, which was these buy stops. Banks took that liquidity again by stopping out those buy stops and then continuing higher and taking the second point of liquidity. Now at that point they can retrace, right, to mitigate orders, and they can continue going higher after stopping out those buy stops as well. Now, one other thing that you guys should know is that uh you know a lot of these banks slash brokers, they do have the information of where the majority of your orders are. They know where the majority of your stop losses are. They know where the majority of your take profits are as well. They know where a lot of your orders are as well. So they're going to be taking liquidity no matter what. So they know where they're going to take the most liquidity, and that's the whole point of trading. The whole point of trading is, where they can take as much liquidity as they possibly can. Now, does everybody understand this example, and does everybody understand the dynamics of this example? Give me a moment. All right. So since everybody understands this, let's go ahead and introduce a variation of power of three. Now, does anybody have anything they would like to say? Any questions? Anything that you guys have had, a little bit of a doubt on? Anything? Because we're about to get into a little bit of a variation of power of three. That is a very, very interesting variation of power of three. Anybody have any questions? Perfect. Let's get right to it then. A lot of people don't know what power of three is. Power of three is a concept, right, that essentially shows how price is going to accumulate, manipulate, and distribute. So let's say that we have power of three listed up here, right? So it's power of three, right? And this power of three is essentially this: accumulate, manipulate, and distribute. Now, what does this mean? Well, put it simply, to put it simply, power of three works like this. Banks will do the following. If they want price to go lower, right? Let's say they want price to go lower. Do you guys remember what I taught you guys about premium and discount, right? How I said that if you want to sell, like I said, if you want to sell these earphones, you're going to sell them at as much as a higher price as you possibly can. Well, if you had the power to drive price upward, you would, right? Because you want to sell it as high as you possibly can. So when banks are accumulating sell orders here, remember that red is for sell, blue is for buy. Right? They're accumulating these sell orders because they have a lot of money. Since they have a lot of money, they're going to accumulate their orders. They're going to stack their orders, right? And boom, they're going to keep stacking more and more and more and more and more and more orders. Boom, 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 right? They're going to stack these orders. Now, because of this, they also want to manipulate price. Now, what does this mean? Well, they want to drive price higher. So if they drove price higher, that would benefit them. That benefit them because then they can manipulate and they can stack even more sell orders there. They can catch the very top. Now, from this position, they can distribute. Now they can get rid of those, of those buy orders that they have below. Now they can close out those buy orders. Now they can push the market to distribute their profit. Now, what happens here? Well, very simply put, price falls and it distributes their profit. So, what does this mean for them? A lot of money, right? This means a lot of money. So, because of that, this whole move down, they accumulated their orders, right? Meant by all of this move. They manipulated by pushing price higher and getting even more sell orders. Then they distributed. They distributed to push price lower. Okay. That is power of three. Now, now that you understand power of three, let me give you a practical application of it. Okay. Every single day at around 12 New York. Okay, so I want you guys to write this down. So it's around 12 New York. It's around midnight New York. Around 12 midnight New York, right? Eastern, yes. So this is New York time. So New York time is Eastern. So every single day around midnight New York time, there's going to be an open of a candle. So usually I do this on the 1 hour chart. So you can do this on the 1 hour chart. There's going to be, let's say price, does this, whatever the case. Now let's say it opens a candle here. Okay, let's say it opens a bullish candle. So this is the opening price. You want to focus on the opening price. Okay. Let's say you focus on the opening price. Right? And let's say this candle goes like this. Right. And draw an imaginary line through it. Right. Draw an imaginary line through it. Make sure to delete this. So let's say from there, right, price goes below. What you want to concern yourself with is what happens as soon as that opening price is made, as well as what is going to happen as soon as that opening price is broken. Okay. So as soon as that opening price is touched. So what do you guys think is going to happen here? What do you guys think is going to happen here? Well, more than likely, this right here, right, is going to get pushed upward and more bullish action happens, right? A buy. So how does this illustrate power of three? Very simply, they have accumulated buy orders here, 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 right? They've accumulated buy orders just to speculate them, right? They have manipulated price to push price lower to give them even more orders towards the buy side. And they have distributed profits to go towards the top side. Now you can use this almost every single day. And if you need help, like seeing where the direction is going or what the opening price is, you can use the previous hour's opening price, or you can also use the previous hour's candle to get you a bit of an idea. So, how you're going to use this? This is the exact same thing in a bearish situation. Let's draw this in a bearish situation. Let's say this is midnight, New York time. Let's say it's New York time, right? Price has been consolidating. Price opens, right? Price opens here at 12 midnight, and then it pushes higher. Now, if it pushes higher from this opening price, you want to say, well, it's pushed higher from this opening price. So what am I going to do? Well, in this case, when you see it in this case, these are the ones that you really want to take or you really want to consider. Once this opening price is broken, or once it's being directed toward it, you want to say, well, price more than likely is going to be, amassing a lot of banks are going to be accumulating a lot of sell orders in the past, right? They have now manipulated price to push it higher. Oh, I'm sorry if I froze. I'm sorry if I froze. Well, what I was saying is that they've accumulated orders right in the back here. They have a manipulated price to push it higher, right? They've sacrificed some of their capital, right, to push price higher. So they actually had to put buy orders here to push price higher. So they sacrificed some of their capital. But afterward, they put in a lot of sell orders to counteract that, right? So once they put those sell orders, what do you think is going to happen to price? Well, it's going to distribute. Going to distribute. And from there, you can easily see how price and power of three is actually being used, right? Is actually how it's used in such an effective way that that you see how you essentially notice how price takes a certain form, right? When it's being institutionally manipulated. Now, there is a difference between an institutionally sponsored candle and being institutionally sponsored. And usually there are two characteristics of these moves. So going back to this example that we had earlier, going back to this example that we had earlier, I want to note something for you guys, okay? And these are like two kind of characteristics that kind of define whether or not you should be taking this move. So, if at your point of interest, by any means, right, there is a kind of sluggish move, or like, price really doesn't seem to be wanting to react off of that move, that more than likely means that price is not institutionally sponsored in that case. Right? So right here, let's say instead of having such like, a high movement or a high momentum move as a reaction here, instead we have a very sluggish kind of, consolidation, like it's very slow. More than likely that is not institutionally sponsored. So what should you do? Well, what you should be doing is you should be either having your risk, meaning closing half your lot size, bail out of the trade completely and say whatever, or just mitigate your risk. Know that more than likely this move is not going to be institutionally sponsored, so be aware of that. Now, this right here, this very very fast move downward that met this point of interest, that is institutional, that is this institutional buy limits, that is known as an institutionally sponsored candle. Okay. This is known as an institutionally sponsored candle. How many times have you guys seen a candle that, some of them is called, some people call them, FU candles and stuff like that. So, how many times have you seen a very, very fast, strong candle towards a certain direction and it stops you out and you're just frustrated sitting there like, why did it stop me out? And right as soon as it stops you out, it goes your direction. How many times does that happen? A lot. For a lot of people, it happens a lot, right? That is an institutionally sponsored candle, a very fast, high momentum candle that reaches a point of interest and reverses off of that point of interest. That is a institutionally sponsored candle. So write that down. Write that down. Another definition would be something like Institutionally sponsored fast moving candle that reaches a point of interest and reverses with high to reach a bank target. Okay. Does everybody have this? I want you guys to write this down. So an institutionally sponsored candle is a fast moving candle that reaches a point of interest and reverses with high momentum to reach a bank target. Okay. Does this make sense to everybody? I hope it does. So perfect. Now that we have it this way, let's go ahead and start talking about, that institutionally sponsored candle is what I want you to focus on. If you don't get anything else out of this, institutionally sponsored candle. Okay, try to look for those. So now let's go back to our power of three, right? So our power of three, a lot of these institutionally sponsored candles will be found in these power of three entries. Okay. So whenever you guys are using them out in the real world, I want you guys to use them in such a way that you guys are looking at them, at 12, at 12 midnight, or you guys can be looking at them earlier because you'll be able to see, how price is actually reacting to that point, and you'll be able to see it in such a way that you'll see how banks have been amassing in the past, right? Have they been amassing bullish entries? Have they been amassing bearish entries? Have they been, proving? Have they been moving price towards the bottom or towards the top? Let's actually look at this example in Great British Pound US dollar really quickly. We see that the actual entry at midnight would be right around here. So this right here is our vertical line that we're going to put in as our marker, right? So that's our marker. Now, now that we've seen that, let's actually see the horizontal ray, right? Let's see the actual point that it opened. So it opened right here, right? It opened right there. So let's see beforehand. Let's see beforehand what happened. Well, it's bearish. Right? Beforehand, it's bearish. So what kind of sorry, beforehand it was amassing, a lot of these and you guys can also use day separators. So like if the last day was around here, and you want to separate your days, you definitely can. There you go. So you know that in the past day, what has this candle been amassing? Well, it's been amassing a lot of bullish entries because we see how price, has created this bullish line. Now, we see that beforehand, before this entry, we see that there's a lot of amassing towards the bullish side. Now, from there, we can analyze the lower time frames and see, well, is there a bullish prerogative? Is there a bullish theory for this? Like, is there a case for this? Well, there is a case for this, and this case is this piece of liquidity up here, this previous high, and this piece of liquidity right here. So if we're analyzing this trade, you could have said, well, we have this piece of liquidity here, and we have this piece of liquidity right here. So yes, we do have a bullish case and a bullish case for GBP USD to go higher. So once you've melded these two things together, you shouldn't just use this off a whim, just like, okay, you see this, cool, awesome. This should be used as almost exactly how Mustafa taught like earlier this week how to use New York entry or New York open. You should use power of three in this exact same way. Use it as a confluence. Don't use it as an end all be all. Okay, use it as a confluence. Now, when you see this open, you see that there's an amassing of bullish entries. Now, from here, once you see this bullish open, you could have easily said, all right, let's go, let's buy, right? So you bought, and from there, boom, you got this whole trade. Now, in this case, in this previous day, we see that there's a large amassing of bearish orders. So once you would have seen that, and you would have seen, price goes back up, right, to amass more orders, and then boom, you could have caught this sponsorship from this drop base drop, right, and then comes back to mitigate the drop, and then goes back down on a lower time frame. That would have been an order block, right? So if you want to do this, you can easily do this on a daily, sorry, on a lower time frame, and you can catch these entries that way. So I see some people typing in the chat. Let me actually the chat real quick. This ties into the London Open strategy. So you can use it with the London Open strategy, but how I suggest you to use it is use it as a separate confluence to get this right. Yes, this is being recorded, and the time is 12 o'clock midnight Eastern time, New York. 12 o'clock Eastern time, New York. So here's another example, actually. Another perfect example. Another perfect example, right? What do we see here? As soon as we see this price, let's use a little bit of our logic, right? And let's say, okay, well, I don't see much of anything. There was a lot of bullish orders, being distributed, but I also see that there was a compression here that, that evolved into this expansion, this bullish expansion. So let's wait a little bit. We wait a little bit. We see London, New York opens, right? New York opens, and what happens? Boom, it fell, right? So yes, you can use it with the London strategy, right? So what happens? This London into New York reversal. So we go into London right here. We amass bullish orders, right? 8 o'clock Eastern happens, and then boom, we dump all of those orders. Why does that happen? Well, very simply, because that is how the algorithm moves it, right? That's something that we've noticed as a landmark. So right now, we don't know what's going to happen in the next day because we haven't reached 12 o'clock Eastern yet. But once we have reached 12 o'clock Eastern, well, more than likely, we see a lot of bearish amassing, right? So more than likely, we can see the reaction of the next couple hours, and maybe we'll continue on bearish, right? More than likely, we can continue on bearish, and from there we can continue our power of three. Now, does everybody understand how power of three is used in this instance? Does everybody understand this? Awesome. So 12 o'clock midnight, right? You see how price action has been reacting previously. You see what happens at the entrance, right? At the open of the price. So the open right here was the open. We see that previously, Will, there was a lot of amassing of bearish or of bullish orders, right? A lot of amassing of bullish orders. There was an institutional manipulation, right? And then it comes back up. So they got as many orders as they possibly could to go bullish, right? And then from there, boom, it shoots back up. Now from here, we see the open. The open's right here. What happens? We come back up. We amass more orders. So what are we most likely going to say? Well, more than likely, this right here, this open price, which is right here. Let me actually get the open for you. The open for you, which was right here. Well, boom, it goes back up, right? It goes up. So when it goes up, what are banks and institutions going to be doing? They're going to be amassing a lot of these sell orders up here while sacrificing some of their liquidity by going upward, right? So a lot of them can get tricky by, by trading this spike. And once it goes back up, right, it starts amassing orders. So that's how you know more than likely it's going to go lower. Now on lower time frames, you can also, this is also the first steps to understanding Asia range, right? Which is something that another one of our educators specializes in. So if you guys tune into his class, Garrison's class, you guys can understand Asia range perfectly. He teaches it amazingly. So now we see that this amassing of orders has we see its behavior. We see that it comes back up. It's obviously amassing orders, right? So then from there we understand that once 9 o'clock hit, which is actually we caught this move this morning. We caught this move this morning and it ended up going what, like 70 pips? Yeah, 70 pips. So and then it ended up going that way, and I think it still kept going. Right? So yeah, around 65. Right now, it's sitting at like around 50, but we took partials at 70 pips. So what do I think? More than likely, it's going to continue on lower. Why? Look at all this amassing of bullish orders. Maybe we'll see one more push back up for a London New York reversal. That's completely fine. We see that London New York reversal, and boom, we keep going on the amassed orders. So that's how we're going to do it. Does everybody understand this so far? This has been a bit of a long class. I appreciate everybody for sticking with me. Does anybody have any questions that they would like to ask? This confluence applies only at market open or daily at midnight. It applies daily at midnight, but it should be a confluence for you to see where the orders are. So it's meant to kind of give you a little bit of like, a little bit of glasses for the market and kind of say like, okay, well, here's 12 o'clock midnight every single day. What has the market been doing in the past couple hours? Has it been amassing bullish orders? Have it been amassing bearish orders? Has it been consolidating? And if it's consolidating, okay, don't touch it. But or look for another point of interest. But if you mix power of three, how I've taught it to you right now, with your confluences that you use right now, meaning your order blocks, your inefficiencies, your Wyckoff, if you like, because this is more than likely lower time frame Wyckoff. But if you use that and you realize that distribution is the biggest example of power of three, because let's think about it. Distribution is literally you have the UTAD, right? The UTAD in distribution, the upthrust after distribution. So that upthrust after distribution literally pushes price higher into discount, right? Accumulating and manipulating orders for price to go upward. And then it distributes by using the test and the last point of supply. And then the sign of weakness. That's so if you understand Wyckoff, you can understand power of three. Power of three is not exactly like Wyckoff, but it has the same concept. Okay. Can you explain the January 12th and 13th midnight bars again one more time? Yes. So the January 12th and 13th. So January 12th, it starts right here, right? We have our open price. So we want to look both sides, right? We want to see, well, what has it been doing here? Well, more than likely, it's been amassing a lot of bullish orders, right? We see amassing here, amassing here, amassing here. There's a bit of an institutional sponsorship. There is a price magnet because there's liquidity pool one, liquidity pool two. So we can say, well, more than likely there's going to be a bullish reaction. What ends up happening, we see, once we see price in the past couple hours, we see that more than likely it's amassing a lot of bullish orders. What happens? Boom, it shoots, right? It shoots. It takes the first liquidity pool, second liquidity pool. Now for January 13th, we see price as it is. We understand that this has just come off of a big expansion. So for me, I probably wouldn't have touched it until London. What happens in London? I see a lot of consolidation. So I would have said, you know what? I don't like to trade this. I'm going to wake up in New York because I usually always trade New York. So since I always usually trade New York, I wake up at 7 and I say, well, what kind of orders were amassed in the last couple hours from midnight? Well, I see that price hasn't made a completely definitive move upward. So I stop and I think, well, more than likely this is lower time frame Wyckoff. I can go on lower time frames and check, right? I check, it is. Now I say Wyckoff has the power of three kind of thought process or school of thought ingrained into it because of the upthrust after distribution, the taking of highs, liquidity, and then the distribution of profits, right? So the manipulation of price being the spring or the upthrust after distribution, right? So we immediately think, well, okay, if it's lower time frame Wyckoff, more than likely it's going to be power of three. So what are we going to say? Well, we can sell, right? We can sell off the lower time frame Wyckoff of the LPSY, right? And then from there, we're going to catch this whole move like we did this morning, right? It's not just something that we teach and don't use. That's how we caught this move this morning, right? With this 70 pip move with GU. How did we do that? Very simply, we used the confluence of power of three, lower time frame Wyckoff, and we also used a lower time frame order block to do that. Okay. So this here, this power of three should be used as a confluence, not as an end all be all. It should be used kind of like glasses, right? So you put on your glasses and you see the market clearly. You use these separators to cancel the noise out. Okay. You use these separators because a lot of people I've seen that people end up getting their time frames mixed up, or they end up seeing way too much for their own good. So if you have to be scrolling out all the way out here to find a point of interest, that point of interest is going to get violated no matter what. Okay? You should be focused on local price action unless you're trading higher time frames, right? If you're trading the daily or the 4 hour, then yes, of course, you want to be looking out and seeing what's up, right? Because there's going to be a lot more time in the middle. But because you're trading on, the 1 hour, 2 hour, 4 hour, more than likely you're going to be want to be separating your days and staying organized. That way you can see what banks are doing today, right? You can say that banks, okay, they're amassing selling orders, right? Whether or not it's conscious, that's what they're doing, right? That's how the algorithm prices it. So the result's going to be the same for us, right? So remember what I said, more than likely it's going to be a retracement, London into New York, and then a continuation sell, right? That, again, we haven't touched midnight, so I don't know yet, but at the same time, I'm going to wake up in New York and try to find something, benefiting towards me. So does that make sense, Zai, for the New York? Sorry, um for the question you asked. I hope it helped. Oh, you got it. Thank you. Um. Oh, thank you, Andrew. I didn't see that you left, but thank you. Um. So you watched the NY opening at 7 a.m. and saw the direction of the market and following as opening of the candlestick, in other words. Yes. So I this is used kind of like a separation, right, to keep my books in order. So let's say that back here, right, I have a case for a bullish GU. Perfect. I see a case for a bullish GU. Let's say this was a previous order point, which it was, right? And from there, price pushes higher. Right now, price pushes higher, it reaches the 50% of this inefficiency, and then it shoots back up, right? However, if we wanted to hold off on this and say, well, I'm not so sure what to do here. I'm not so sure where the market is going. Let's say I don't even want to trade it. Let's just say I want to find a point of interest and see where it goes. Well, in this case, I could say, well, let me watch the open of the candle at 12 o'clock midnight. What happens? Well, in this case, we see that there's bullish manipulation, right? Because it goes deeper into discount to amass more buying orders. And from here, it should buy. What happens? London, New York, it buys, right? The next day, we see this here, right? We see this lower time frame distribution, right? In New York, we wake up at 6 in the morning and we say, well, what's going on here? We see that this lower time frame distribution goes back up, it mitigates an order block, and then from there it falls. Why? Because at this price, right around this area, is this upward level right here, which is essentially how price indicates, hey, I'm manipulating price to go upward, amassing more sell orders to push price down in the future. Does that make sense? And if you guys want to know a lot more about Power of Three and how to use it on the daily, I'd suggest you guys to check out Bootcamp 5. Okay, if you guys don't have Bootcamp 5, please go to the website and go to, I think it's the 300 level classes, and from there look at my Bootcamp series. It's something that I think you guys will enjoy very much. Okay, and I'll also send it in the chat here just in case, and I'll send it also in the other. Hold on. And I also have another class that I did earlier this year that goes into advanced scheduling and into Power of Three stuff. All right, guys. So apart from that, I think that is about it. Does anybody have any questions they um, that they understand, those that they want to know? Anything that says Power of Three, Mitch, you can watch, and it'll have information on Power of Three, like the title says. Also, I was using this book to hold up my phone while I was writing. I suggest you guys read it. It's very good. It's called An Empire of Wealth by John Steele Gordon. It's very, very, very good. It gives you a lot of good insight on how the economy works in the US. All right, guys. Thank you guys so much for being on. I appreciate all of you. Thank you guys very, very much for your attention and for your time. So all of you guys have a good night. If you guys have any questions, I'll still be on. I'll still be on for the night, and you guys are very much welcome to go ahead and text me. So, yeah. All right, guys. Thank you guys. Have a good night.